This is Ryan Carr's evaluation process of the abnormal models. And I will start with my Under Armour evaluation. You should be able to follow along with the Excel file that was submitted via the team site. So if you look through it, I started obviously with the template that you provided. I was able to get the shareholders' equity for those 3 years in question there. You can verify those numbers against what the SEC documents provided from their 10K. So I provided the link down there. You can go to the link, and I also pointed out what page I found each one on. So as you can see, the shareholders' equity has increased quite significantly over the past 3 years. Under Armour's kind of a cool company to evaluate. It's significantly been growing with their retail and clothes and shoes. So I was interested to see how they were doing. And I also put some notes and comments down there as far as how I got to the number of shares outstanding, where I found them on the 10K form. So I went through and I got those numbers, which then would populate the Exhibit 6.9 tab. But then if you go to the Assumptions tab, where I filled in the forecasted EPS increase, I went to Yahoo's analyst estimates, which you pointed out, and they were forecasting 23.44% growth percent for the next 5 years, which is kind of amazing. You know, I was a little skeptical to put that in there, but you can see over the last 5 years, if you go on Yahoo or wherever and look at the financial numbers, you'll see that they've increased their growth a little over 19% for the last 5 years. So I didn't think it was that far-fetched to do 23.44. Now, I sent you an email and you responded, and it seems like I did it at least the appropriate way, but the discount rate is extremely low because their beta is only 0.25, which, you know, is extremely low. You know, 1 is the market average, so it's a quarter of a percentage of the market average. So I used that beta with a 10-year average, historical average of the market return to get the market return, and then I used the 1-year Treasury risk-free as my risk-free rate at the time period of December 31st, when the balance sheet and the income statement or the 10K form was sent out. So I use that, and see, so the problem with that is as far as developing my forecasted growth, abnormal earnings beyond 5 years, I couldn't do anything too big because my discount rate ended up being 2.55 after I used those metrics that I just provided. So I can't have anything above 2.55 because since the present value of a perpetuity is deducting the growth rate from the discount factor, the discount rate, it would come up with a negative denominator, which then would create a negative abnormal value for my perpetuity. So I had to I only picked a 1% growth, which, you know, I think isn't that far off. And then as far as the forecasted stock, the forecasted dividends they haven't had, so I didn't use any dividends. And the other earnings, or the other things, they had quite a significant, not significant, but, you know, 0.33 as an average for the last 3 years. So I wanted to continue that. So I thought that was consistent. So I just kept that at 0.33, and the stock the same thing. It was just an average over the past 3 years. You plug those into the Exhibit 6.9 tab, and it comes up with the abnormals model. I mean, as you know, and as we've learned, it takes the book value, it multiplies that by your discount rate, and then it figures out what your forecasted earnings per share is and subtracts that book value times the discount rate to get your abnormal earnings for that year. And then you use the present value factor to factor that back. And that would be for the first 5 years. And then you use the present value perpetuity formula to get to the total amount. And then so you would sum those up. And I got a pretty high price, compared to the actual share price. It was 139 is what my hypothetical was to the 67.90 is what the actual share price was at December 31st. I thought it was kind of cool that that as of this date, and I put it down here in my comments, and you can read through it. Under Armour stock price is up over 100. When I wrote this, it was at 100, and it actually has, again, it's had a couple of good days, and I think it's at 111 as of today, which is 10/5, 2015. So my share price is actually getting very close to my share price that I've calculated. So it was off compared to in December, but I think it might have shown that there was a value there, that the price that the value of Under Armour was being undervalued, and it was a good opportunity to maybe buy some stock or any sort of investment that you could have in that company. So I think that was pretty cool. So not to ramble on, so that's pretty much my Under Armour one. If we go to the Yum one, which Yum I've always thought is a cool name as a company, Pizza Hut and Taco Bell. Went through, did the same process. No need to dwell on it. I put some links in there as far as where you can find the 10K, and I showed what pages you can find each item that I was able to get to. So it's quite a bit different from Under Armour in a sense that the shareholders' equity has decreased each of the last 3 years. So you can see it's kind of going in a different direction, and the assumptions, the earnings per share, I found the analyst again on Yahoo forecast 11.59%. I thought it was a little high. I didn't necessarily like that based upon their last 5 years average has only been 2.94. So I did just an average of what the forecasted for the analyst were and the historical average for the past 5 years to come up with my 7.25 or 7.265% for the forecasted growth rate for the next 5 years. I know that's a little bit of an arbitrary number, but I actually like it a little better than the 11.59, seeing how the historical average has only been 2.94. And then I use that same abnormal earning in year 5 and beyond, which might be a little high now thinking about it. But I still think it served at least a little bit of the purpose. I don't think, even if I lower it, I don't think it changes that much. While I'm here, let's see, it's currently at 41. If I would lower it to like, I don't know, 4, it lowers it to like 27. So it does lower it a little bit, but it still, I think, serves the purpose of this exercise. And the discount rate, same process. Market returns the same. Treasury rates actually slightly different. It's it's 0.01 basis points. Anyway, it's 0.12 versus 0.13. Because the 10K was submitted on 12/27 versus 12/30. Apparently, the Treasury rate changed from 0.13 to 0.12. So it doesn't really change it that much. And then the beta is 1.25, which is significantly different than Under Armour. So you go through there and you plug in your discount rate, the forecasted stock. They had repurchased stock the last 2 years of around negative 1.5. So I continued that for the first 2 years, but then I also tapered it off a little bit. I didn't think that they would be repurchasing stock for the next 5 years at that same clip. That seemed a little high to me. And then the dividends, they've kept consistent for the past 3 years. I kept those the same. And the other things, again, just a mean historical average of the past 3 years. And then if you go through there and plug it in and run that same abnormal model, I show that that the share price is about $30 less than what the actual share price is, which if you would have used, I guess, the analyst estimates of the 11.59%, you would have been a lot closer to that. But personally, from my evaluation, I don't think it's worth the current share price, and I could, easily not be willing to invest, I guess, in this amount. Now, obviously you can change a couple of numbers. If the discount rate's a little lower, the share price is going to go up. If the earnings per share is a little higher, then the share price is going to go up. So there's a lot of fun things to play with to figure out what it is. So you just need to nail down what you actually think is the true estimate of what it's going to come out to be. So it was kind of cool comparing the two, because I think I got opposite ends of the spectrum. I got Under Armour, which is on the rise, and I got Yum, which not necessarily on the decline, but you could see that the shareholders' equity has gone down each of the last 3 years, and that their growth has not been nearly the same. Their EPS is been significantly on a dive. So I'll now be curious to see whether they turn it around or not. And when I was doing the compensation project, it was kind of cool that they ended up firing or he resigned, the CEO. So there's going to be a new CEO, and you can easily see maybe why, because they haven't necessarily been doing extremely well in the last 3 years. So pretty cool exercise, and those are my valuation projects.